This is the current federal tax developments for the week of July the 25th, 2016, brought to you by Nichols Patrick CP Incorporated and your state society of CPAs. I'm Ed Zollers, and I'm going to be talking to you this week about some of the interesting and maybe not so interesting, but still things we need to worry about, issues that have occurred in the area of federal taxes. This week, we're looking at a course, or a session that really talks about some of the odd things that have occurred in the way of fraud and changes in procedures that we're going to be seeing from the IRS based on the fraud issues. So we're going to talk about that as part of it, highlighting this week. Plus, we have some other developments in the area. For instance, some of the key developments this week, the IRS, as I note, restarts the IP PIN reissuance program. So we'll talk about that, what changes we're going to come into there. The IRS decides that, again, they need to mail taxpayers notices before starting contacts with phone calls in another area besides starting exams. So we'll talk about that particular development for the week. We'll also talk about the fact the IRS has created safe harbors that apply to certain transactions that we're going to want to structure under Section 355. We'll answer the question, do you need to own an oil and gas property to get the benefits of Section 167H's special rules for geological and geophysical developmental expenses? We'll take a look at how the tax court thought about that answer. We also discovered that the tax court will tell us, or I should say, in this case, not the tax court who thought this was the case, but the Court of Appeals for the Seventh Circuit tells us that excessive does not include simply unfair assessments of interest. And finally, we'll take a look at another interest issue where a taxpayer was trying to block the assessment of interest on a transferee liability case for any interest that accrued prior to the time that the taxpayer was given notice of the transferee liability. Now, as I said, we're having a lot of things going on here. We're well into CPE season, so we have some things coming up now in the States. And I want to take a look and remind you that coming up at the end of August in New Jersey, Bob Gilwey is going to be doing sessions in Iceland, New Jersey. First, on August 30th, he'll be doing a business and industry tax update that'll talk about tax developments, changes in the laws, the things we kind of talk about here that affect business and industry, though, and not the individual sites. We'll be concentrating on business and industry developments. He'll also be doing a session on partnership and LLC taxation, advanced issues, and of course, we'll be talking about, to some extent in that course, the wonderful new partnership audit regime, which has been one of the more interesting things that's happened to us in partnership taxation this year. Interesting in the idea, not necessarily welcome, but certainly something we have to deal with. Also in August, I'll be doing some courses in Albuquerque, New Mexico, beginning on the 24th with a course on construction contractors. So I'll be looking at tax and accounting issues for construction contractors on August 24th in Albuquerque. And on August the 25th, I'll be doing a session on corporate taxation, subchapter C for C and S corporations. So the key takeaway here is we have a number of courses coming up in your state societies. This is just some examples. Be sure to check your state society's catalog for those things that are coming up and the things that we're going to want to be looking at going forward. With that, let's go ahead and take a look at this week's session. And some of the things that happened this week, we're going to start with the issue of the IRS restarting the online Lost My IP PIN program. This is the IRS statements on the IP PIN program that was updated on July the 19th. Now, you may remember earlier in the year, the IRS had a little problem here. The IRS had discovered that at least 800 taxpayers who've been issued an IP PIN. The IP PIN, let's remember, is that set of digits you're given if you were a victim of identity theft in the past that you have to send with your electronically filed return or put on your paper filed return for the IRS to process your tax return. This is to hopefully stop fraud from occurring a second straight year because the fraudsters won't have the IP PIN. Of course, one of our problems in reality is that people lose things like the IP PIN. Question becomes, how do we get them reissued? The IRS had a method to go online and get them reissued after answering some questions that the IRS believed only the taxpayers could answer. Turned out the IRS was wrong about that in fact these out-of-wallet questions were too easily answered. And it's interesting because the IRS still found that about a fifth of all taxpayers couldn't answer the out-of-wallet questions. But statistically, when we looked at the transcript program, half of the fraudsters got the questions right because you could accumulate this stuff online. They were, in some cases, better at finding out things about the individual than the individual was. Now, this new program is going to use the same authentication mode that was put in place with the revised online transcript retrieval program, which came back a little while back. You remember we discussed that. One of the key problems you're going to have there, though, is the nature of information to be requested is going to be more detailed and more obscure. So your first problem is that taxpayers, again, 20% couldn't answer the questions to begin with. We've got to assume more than 20% won't be able to answer these. Also, there are some additional requirements here. One of those requires you to, in essence, both give the IRS a current loan number or credit card number they can verify you with, and then so they can go back and check that with a credit bureau. And they also are going to want you to be able to receive a text message on what they'll refer to as a verified cell phone. A verified cell phone is going to be a phone that is effectively a postpaid cell phone service. That's a traditional service that you would get from AT&T, Verizon, T-Mobile, Sprint, because they run credit checks on you and they effectively verify your address. If you have a prepaid program, and all four of those vendors offer prepaid options themselves, most of them own their own other companies that lease space from them and sell prepaid. And then there are things like Google's Project Fi that also does the same thing, leases lines from the big four. In the case of those postpaid or those prepaid programs, that's not going to be considered a verified address that could receive the text. So if a client, for instance, has a Google Project Fi phone number, because that's a lot less expensive than paying Verizon for a phone number, that's great, that's wonderful, but they won't be able to retrieve their IP PIN if they forget it. The practical takeaway from this is I suggest you tell all of your clients just to presume that the IP PIN, they need to keep the one they get via the mail. If they lose that one, it's going to be very troublesome. And in fact, we may simply not be able to file the return in the fashion they'd like. We can get it filed. If they lose it and they can't get it reissued, we can file it on paper, but it's going to take a lot longer to get processed. Next up, we have another little fun issue that have occurred. This is a small business and self-employment group memo to the IRS agents, SBSE 05-0716-0035, issued on July 18th. This deals with the IRS's program where they reach out and contact taxpayers who have a sudden decline in their federal tax deposits, most often have it suddenly disappear. The concern being these taxpayers are falling behind in their federal tax deposits, and they may be exposing themselves to all of the responsible person penalties and other problems they may not realize. So the IRS has had a program going for a while here to contact those taxpayers. The problem, of course, is sometimes that first contact is by phone. The problem, as we can expect, is fraudsters have been pretty good at pretending to be from the IRS, contacting taxpayers by phone and demanding all kinds of neat things. So unfortunately, these calls sound a lot like that type of fraud call. And secondly, it also means that we can't simply tell taxpayers, neither can the IRS, that the IRS would always contact you by phone first. They would never, they would always contact you by mail first. They wouldn't just call you out of the blue. Well, the IRS has figured out, again, the first time they did that with the exam rules that we got them backed off of. Now they figured out this is probably not a good idea to contact people by phone first. So now they must send a letter before the phone call. If you take a look on the website and download our articles for this week describing the developments, you'll find the actual example letter the IRS has published in this area and what exactly they're going to be sending out. So you'll see the type of letter that they would send ahead of time. They are always, this was effective immediately, to send that letter out prior to attempting the phone contact. Now, they may also, the letter will talk also that they'll say, well, they could come by phone, they could visit. The memo makes very clear, though, that an IRS agent, IRS revenue officer, could visit the taxpayer without sending this letter out first. So it's no guarantee this letter will come out before someone shows up on their doorstep, but there is a guarantee they won't get the phone call. So your clients who are in business should be warned that, if somebody calls claiming you're behind your payroll taxes, you should have received this letter first. As always, what I always tell the client is, take the information from them and then verify with the service or verify with me, with those of us at our office, that in fact this appears to be a legitimate call. We can talk about the pros and cons, all these issues, but the IRS is slowly but surely figuring out that unsolicited phone calls, ones that come from the IRS as first contact, are just not a good idea in today's society because of all the fraudulent calls. We'll see if the IRS, we'll see how that works out with the collection calls we'll be seeing starting here shortly from collection agencies. But basically, yeah, it's not a good idea for the IRS to be calling people out of the blue. And it seems like slowly but surely the idea is sinking through. Next up, an oil and gas matter for us. This is the case of CGG Americas Inc. versus Commissioner. This was a published tax court decision, 147 TC number 2, issued on July the 21st of 2016. And the question we had to deal with here was, does a taxpayer have to actually own oil and gas properties in order to be able to claim a special benefit under 167H? For those of you who are not in oil and gas, under 167H, it says that a geological and geophysical expenses paid or incurred with connection with the exploration for or development of oil and gas in the United States can be allowed as a deduction over a 24-month period, more rapid than you'd be allowed to develop amortize intangible assets otherwise. So a very rapid period of time. Now the question became, do you actually have to own oil and gas property? The company in question, CGG Americas Inc., is a company that actually uses acoustic data to map out likely oil deposits just offshore in the U.S. in the Gulf of Mexico area. And this organization does this work. They use sonar, they process the data, but they don't actually do any of this, actual oil exploration. Rather, they sell this data to companies that do exploration. These companies don't have to go out and do this sonar work on their own. They don't have the equipment to do so. The only use of this information by any of their customers is for oil and gas exploration. In this case, the taxpayer, CGG Americas Inc., went ahead and took these expenses over 24 months. The IRS objected and say, no, you can't get this unless you actually own oil and gas wells. The IRS spent a lot of time in their position pointing out all of this from the congressional record and congressional committee reports that came into place when this provision was added to the law, stating that what Congress intended to do was to allow to free up capital for people who were producing oil and gas, and they would be able to then go out and do more exploration. CGG Americas does no exploration in and of its own, so freeing up capital for them would not, directly cause additional oil and gas exploration to take place. The tax court, noting that information from the congressional record, also said that it's not relevant. What's relevant is not what Congress wanted to do, but what Congress actually did in the law. The court noted nowhere in the law did it say you had to actually own wells in order to have geological and geophysical expenses. And secondly, as long as you were involved in some way with the development, exploration development for oil and gas, you didn't have to yourself be doing the exploration and development of oil and gas. The tax court found that CGG Americas should be allowed to claim a current deduction for this amount, that they should not have to actually own the wells. Next up, we're going to talk to you about a revenue procedure from the IRS. This revenue procedure, which comes under Section 355, gives us two safe harbors for transactions under Section 355. Section 355, for those of you who may not, remember your code sections right off the top, is when you're going to try to distribute out part of your corporation to shareholders in a tax-free distribution. So you're going to send shares of stock, you're going to push out shares of stock in a new corporation to your shareholders, and we're going to be able to pull that off in a tax-free manner under Section 355. One of the key requirements of Section 355 is that you must have control, that the company doing the dispersing must have control of the entity for which it's dispersing the shares, prior to the actual distribution. In some cases, what happens is that subsidiary ends up issuing more shares to the parent in order to get the parent up to that 80% level before the distribution. The problem, of course, is that if afterwards we then get the minority shareholders back to where they were by some other transaction, like maybe issuing them more shares after the distribution, then the problem becomes, was that control real? The safe harbor gives us two conditions, or in essence, two separate situations where if you meet these requirements, the IRS will not assert that your transaction was false. Let's say, a fake transaction didn't count. The first safe harbor looks at whether or not you have a reversing transaction, one that puts the shareholders, including the ones who are part of your company, and then the minority shareholders back into effectively their same position within 24 months. If nothing of that sort happens within 24 months following the distribution, basically, then we are considered to not have had, we're basically going to be allowed to consider to have had control before. We're not going to be considered. The idea of the service is if we wait 2 years, that indicates pretty clearly that there's been a risk of things changing in the interim. It also indicates that that risk, which has been borne by all the parties, effectively means that this transaction no longer relates to the distribution, so that control prior to the distribution will still be considered valid. The second rule we have here dealt with an acquisition after the distribution, where a third party later comes in, makes an offer, and acquires the distributed company. And after doing so, the shareholders end up again in a quasi-reverse transaction. In this case, the IRS said, so long as there was no work before the distribution, the 24-month period before the distribution, there was no any sort of type of arrangement, discussion, any of those things about a potential transaction prior to the distribution, that the IRS will again not consider the control to be illusory control, and will go ahead and allow the transaction to be treated as 355 if it otherwise meets requirements. And by the way, that's not a small if, that's a big if, because there are more requirements than merely having the 80% control. Next up, we're going to talk to you about whether unfair interest is excessive interest. This is the case of King versus Commissioner, case number 152439 from the Seventh Circuit Court of Appeals, 2016, tax notes today 141-12. This was issued on July the 21st. The tax court had decided, here's basically the background. The attorney in this case had not been paying his payroll taxes. Well, he got behind. IRS finally gets a hold of him, says, you owe us some money. The attorney said, okay, I owe you the money, but will you give me an installment agreement so I can pay it over time? The IRS indicated that, hey, okay, yeah, we can probably give you an installment agreement. However, about 2 months later, after looking at the details of what was available for him, they decided he could pay that out of pocket. The IRS said, we're not going to give you an installment agreement. The attorney in question paid the tax eventually, and paid the paid the tax in question, but he asked for abatement of the interest, stating that he would have paid it earlier had the IRS not misled him into believing he would have gotten an installment agreement. The tax court decided that due to that IRS misleading of him, that made the interest unfair. And they said, well, the IRS should abate interest if it's unfair. Now, Section 6404A provides a general rule that says the IRS can abate the unpaid portion of any assessment of tax or any liability in respect to that in regard to, among other things, an amount which is excessive in amount. The tax court had ruled that an unfair assessment was by definition excessive. Therefore, the IRS abused their discretion when they did not abate this interest. The IRS appealed this decision. Now, interestingly enough, it appears the total dollar volume here was like $500, but the service didn't want to leave this decision on the book. They appealed to the Seventh Circuit. The Seventh Circuit found that the tax court had overstepped its boundaries, that excessive does not include unfair. I mean, unfair does not automatically make it excessive. Rather, it had to be excessive in amount. The Seventh Circuit also noted the IRS's own regulations limited the term excessive to measurements of amounts that were excessive. And the tax court had ignored that, saying, well, that disregards the plain language of the code. The Seventh Circuit said, no, that doesn't disregard plain language. The language could be interpreted differently. That's clear. In fact, they said the tax court's own interpretation makes it even more vague. So they said, under the case of going back to the case that we had with the Mayo Foundation case from the Supreme Court, that as long as that regulation is reasonable, the tax court has to apply it as if it was the law. Therefore, it was not considered to be an abuse of discretion for the service to not abate the interest in this case. Interesting aside, again, the issue was not so much the amount, because the IRS probably didn't care about $500. It costs more to litigate than that. They didn't want that left on the books. Next up, and finally, we have the case of Tricariarchi. Oh, I know I did his name. A total disservice versus Commissioner, Tax Court Memorandum Decision 2016-132, issued on July the 18th. This case had been before the tax court before, and transferee liability had been found in that earlier case. This was one of those cases where they had a corporation, that he wanted to liquidate the corporation. The problem was it was a C corp. It was going to pay double tax because the buyer only wanted to buy assets. In a midco transaction, this was a marketed shelter. A third party came in and said, oh, no, we can solve this problem for you because we have some magical way of using our losses against the income be generated by your corporation. So we'll buy your stock from you. Then the buyer will give us the cash, and we'll use that cash to pay off the note to redeem your stock. And voila, we'll have to pay no tax, and you'll get to just have a single level of tax. Isn't this wonderful? Well, in many cases, the courts have found that, as you found in these cases, that simply didn't work. And the corporations owed tons of tax, but they had no money left to pay it. So the courts had found that the taxpayers in those cases should have realized the deal was too good to be true, and they've imposed them with transferee liability where they need to come up and pay the tax that was due at the corporate level. That had already been decided here. What we were looking at in this case was whether or not the taxpayer in this case, who was the shareholder, would owe not only the interest and penalties, but did he also owe interest for the period from the time the tax was due until the time the IRS gave notice to him that they were going to hold him liable for transferee liability. He said that this should be governed by Colorado state law that looks for this kind of transfer, where you're trying to defraud creditors. And under Colorado law, there is no pre-award interest is not allowed. Interest only starts to accrue after there has been a determination that there was a fraudulent conveyance. So he said, well, under Colorado law, no interest is allowed to be charged. So that interest IRS you're trying to collect from the corporation for the period from the date of assessment until the date that you told me you wanted me to pay it, you don't get that interest. The tax court said, not so fast. The tax court took a look at a couple of other cases and case law we've had before and noted the way this rule works in this case is if the taxpayer in a transferee liability case receives assets that are greater than the federal taxes and interest and penalties, then the taxpayer, the transferee, has to pay that interest because that interest is part of what they were liable for. It's part of what they basically defrauded the government from by taking those assets. However, if the assets are less than the total of those items, then we look to state law to see whether the state law will separately impose on the transferee interest during the period before there's a finding of this fraudulent conveyance. And only then would Colorado's law, which didn't grant such a right, be relevant. But as it is, we don't particularly care. So, heading on. So this has been kind of the cases for this week. It's been interesting, and we're here in summer. Remember, your state societies still have all the courses available in tax, in accounting, in all those useful areas, and those by us here at Nichols Patrick, as well as those by other vendors that'll be presenting. So you want to be sure to check your website because there's lots of courses and there's lots happening, both in accounting and tax. So be sure to keep up and keep going. And this has been the current federal tax developments here for the week of July 25th. Be sure to check our updates at currentfederaltaxdevelopments.com during the week. As things happen during the week, we'll post updates there. You can also there to subscribe to an email newsletter that when we post something new, you'll get that emailed to you in the morning. So if you don't want to go check the websites in the morning, you can just get the emails. You get the emails, something happened, and we'll tell you about it. If you have any questions or comments, send them to me at edzollers@currentfederaltaxdevelopments.com, and I'll try to get back to them to you and try to answer any of those that you might have. Also, you can follow me on Twitter at edzollers, and there usually whenever we post an update, I'll also post it up there. So you can follow us there. Be sure to join us next week as we'll take a look at brand new developments for the coming week here in the area of federal taxes.